Good morning, ladies and gentlemen, and a very warm welcome to you all. My name is Ivan Glavis. I'm one of the partners in the Melbourne and Essendon offices at Worrells Victoria. It's my pleasure to co-host this morning's session together with Nikhil Khatri from our Worrells Brisbane offices in Queensland. Today, our senior partner Simon Cathro will be presenting on what I personally believe to be a critically important topic as we navigate our way through 2021 and on to 2022. And that is, what is an advisor's role during the COVID recovery? Simon's presentation will provide a comprehensive guide to assist your clients in navigating a company's solvency as we enter into the next economic phase of COVID-19. And with the end of JobKeeper scam only a few days away, it's fair to say that Simon's presentation today could not have been more timely. Simon's presentation will cover directors' duties and responsibilities in managing a company whilst highlighting the different roles managers and companies boards play, the unique challenges posed by the COVID economic environment, the role of advisors and who they are and how they can assist, and the options available to advisors and, of course, their clients. Before I hand over to Simon, I'd like to cover some operational issues. If anyone encounters any technical issues, we are recording the webinar, which we'll make available at the conclusion of this session. You're also welcome to distribute the presentation to your colleagues who are unable to join us today. If you have any questions throughout the presentation, please submit them during the chat function. Before the presentation concludes, we will try and address as many questions as possible, time permitting. If we don't get to the questions in time, one of our partners will certainly respond to you in the next few days. And finally, we'll be emailing the CBD certificates to you with the meeting, and your continued professional development requirements will be updated. Now, without further ado, a very good morning and welcome to our Worrells senior partner, Simon Cathro.
Thank you, Ivan, and welcome, Nick. And good morning, ladies and gentlemen. So, as Ivan alluded to in his introduction, we're here to talk about what is an advisor's role during the COVID recovery. So, just to kick that off, we just from a public health perspective, there have been endless reports of developments of vaccines and the urgent rollout of these vaccines to help stem the spread of COVID. But from our perspective and for today's purposes of the presentation, what are the economic and financial impact that COVID has caused? Are we in dire straits or are we bouncing back? Well, the situation is still unfolding. We've seen as recently as yesterday the lockdown in Brisbane. But today's presentation has been written with the acknowledgement that we are still all operating within an environment of uncertainty. We wanted to provide you with a guide on how you as advisors can assist, supervise and support your clients to be able to restructure, innovate and grow their businesses, and what formal and informal options might exist. So in other words, how do you become more intimate with your clients? So just before we kick off, we've got our standard disclaimer. And given the uncertainty of the economy and where the economy is moving, we'd like to commence this presentation by outlining that the views, opinions and thoughts provided during this presentation are those that we have gleaned from our vast experience of being in business in the last 48 years and from the recent events, expert experience, law changes, conversations and observations that we've collated together into this one presentation. So do feel, as Ivan mentioned, do feel like you can ask questions in written format during the course of the presentation. So moving into the slide, into the agenda, our presentation will be split into 4 parts. The first will focus on the director's roles and responsibilities. What are the critical steps and actions the directors must take to recover, restructure, and then grow in making their business a success? And in addition, what are the legal responsibilities they have to their stakeholders and interested parties? We will then discuss the permanent and temporary changes that have arisen because of COVID. How have your clients, customers and suppliers, bankers and employees changed since COVID started? And how does your client change their business to meet these new challenges and expectations? Thirdly, as you are the advisors to these business owners, what proactive steps can you take to assist, support and advise your clients? What changes will occur to you in advising your typical client? Because for example, the increased digitization of most of your clients' businesses throughout this period. And finally, we'll outline those options available to advisors and their clients when a restructuring is required for a financially distressed client of yours. We'll briefly include a discussion on the new insolvency laws, but for those that attended our last seminar series, we held a very detailed outline of those insolvency options. So if you wanted more information on that, please reach out to the Worrells contact or through this webinar. Okay, getting into the core of the presentation. So the first part of the presentation I want to talk about is director roles. To kick off that part of the discussion, we need to touch on one of the legal responsibilities for all directors when they consider to accept a role as director, and that key responsibility relates to insolvent trading. Section 95A of the Corporations Act deals with the definition of solvency. In essence, that section states that a person is solvent if the person is able to pay all the debts as and when they become due and payable. It then says the person who is not solvent is insolvent. Now, at its most basic level, the Corporation Act attempts to legislate that directors must ensure that they maintain a business that generates a profit. To generate profit, the business must be able to pay the debts it accrues and generate revenue which enables them to pay those debts. So as a business owner or a director, if you generate sufficient revenue to pay your debts, then you are in the enviable position of having a solvent company. With the commencement of COVID, the urgent steps of legislative protections and stimulus packages rolled out by the government saw essentially the temporary removal of this positive obligation for business owners and directors to avoid trading whilst insolvent. And with the removal of that protective legislation now coming into force since the 1st of January 2021, we now see a return to business owners and directors having to ensure that this primary obligation to avoid insolvency is met. So how do we monitor, deal and ensure solvency of a business? To answer this question, we must firstly understand the functions of a board. Now, most people might say, hey, I've got a small business, I don't have a board or need a board. Now, that might be true, but what does not change is the fact that as a business owner, even a sole trader, the essential functions of operating a business still exist whether you run the business with board meetings or not. With COVID now causing some form of disruption on your client's business, it is now that the business owner or board must review, create, or revitalise their strategic plan, understand their resources and current performance, and then determine whether compliance and risk initiatives need redefining. From that, the business owner, usually with your assistance, can build a strategy. So the first part of this presentation will aim to cover off on these functions. Now, in building a strategic plan, it's important that the business owner, their advisor, and the business's employees have a clear understanding of the business's purpose and goals. It's pointless running a business if the key stakeholders do not understand why they are in business in the first place. With the COVID impact, these stakeholders need to question whether the business purposes and goals are still the same or need refining. Once the purpose and goals are set, the business owner must then ensure that they develop a plan that is clear and measurable and have a pathway that is realistic and achievable. Now, that strategy is usually a 3 to 5 year horizon. And if there is already one in place, review the existing strategy that may otherwise have been prepared prior to COVID. Ask questions like, what part of your business have seen temporary or permanent changes because of COVID? So what needs to change? What are the financial impacts of these business changes? And finally, what steps will be put in place to oversight and manage performance? What is the accountability that exists within the business, both for the business owner and other stakeholders? So sometimes the directors need to undertake an element of self-reflection to ensure that they are meeting the expectations of the new business environment that they operate in. So depending on the size of the business, the owners, directors and/or management must consider the kind of resourcing they require. Does the business require a CEO? At what point does a business become large enough or important enough that it requires a CEO? Is it based on revenue growth? Is it based on the number of employees? Is it based on the number of locations? What market share they may otherwise have? Or what are the competitors actually doing? So consider all those different elements when deciding on when a CEO should be hired. Now, does a business have a regular and disciplined approach to managing the business budget and business plans? Capital expenditure. How has capital expenditure been undertaken? And is it a key part of the business? Does the business have a process in place for automatic plant and equipment replacement? after it reaches the end of its useful life? Are new and improved plant and machinery options being developed that will make the business operate more efficiently? How often are the business owners and you as advisors holding discussions about capital expenditure? But does the business have a developed succession plan in place, or does it actually need one? Maybe your client has goals to sell the business to private equity, list the entity, or wind the business down upon retirement. If a succession plan is necessary, what steps is the business taking to identify, train, and develop individuals that could be the right person or persons to achieve a successful and smooth transition? So one of the key parts of the roles and responsibilities to ensure that the business owners and management are undertaking is a regular review of the key performance indicators in a business. So as liquidators, we often find that many insolvencies are caused by poor management, that is management that fail to undertake any form of regular review of financial performance. Whether a board meeting is held or a management meeting or even a regular catch-up with you as the advisors, the entities that fail don't have any of those in place. So even strong performing businesses can often fail in this position because the owner says, well, the business is going so well, why do we actually need to do this? Well, the answer today is actually much easier. We've just gone and experienced an unexpected and unplanned hit to the economy called COVID, or what other people allude to on the unexpected events, it's called a black swan event. Now, what was interesting in our catch-up with our network and contacts during the course of the COVID lockdowns was how well our referrers moved themselves to focus on working capital and in particular the collection of their own debtors. We saw within the accounting industry a swift and prompt reaction to both assist their clients with government initiatives such as JobKeeper and the Cash Booster to making sure that their own debtors were being paid. These same fundamental approaches need to be undertaken by your clients. Those stronger performing businesses will often have solid monitoring, collection and accountability policies in place to ensure the success of the business. Now, just around compliance, this is linked to performance and accountability. As advisors, ensuring your clients have proper systems, processes and policies in place is one area that you can expand your role as the advisor. The COVID experience now gives advisors the opportunity to proactively communicate with their clients and ensure that this area is running effectively. Now, as businesses grow, the importance of having proper systems in place to manage risk are critical. For instance, in a manufacturing plant, the safety of employees is top of the list. But in a professional services business, risk might relate to professional indemnity and the provision of providing proper advice. So having a process to design policies or a risk framework may be required. As advisors, you need to ask your client whether such a framework is necessary, and if so, what are the key elements to designing that framework? The other element of risk is asset protection. Now, as advisors, we are often asked to structure a business in a way to protect the business owner's personal wealth from financial risk in their business. The use of a family trust or a corporate entity or some other structure might be what is required. So have a think about that opportunity now. More importantly, it's necessary to have the correct documentation in place from the beginning. This may be having a proper shareholders agreement in place, or a constitution or a trustee that works for that business, and ensures that it incorporates proper operational and elements and accountability. These documents define value and allows for a smooth transition to grow the number of business owners or implements a proper succession plan. Now, both areas of accounting and law is where you as advisors can assist your clients. Also, clients can now have access to online programs such as Xero and MYOB, or even online legal documents such as the small business called Prodoc, which provide online shareholders agreement that business owners can access to manage risk in their business. As these service providers become more digitized, sophisticated and intuitive, business owners can now properly set up their business for little cost. So what COVID highlighted to all of us is that disruption to your business is more relevant today than ever before. The need to be able to protect your client from black swan events or have a process or documentation in place to change or even wind down a business before it's too late is very real. So with any high-performing businesses, you always have strong accountability processes in place that outline clear and measurable key performance indicators. I can't recall a business that appointed me as an external administrator that had completely proper accountability processes in place. What we usually see is possibly a strategy that is often outdated or unrealistic, annual reviews in place for staff that relate to weak or non-existent KPIs, and a lack of regular budgeting or financial review processes at either board, business owner or management level. It's here as advisors that you can add value to your clients, assisting them in building and implementing accountability into their business. The benefit of having such processes in place is that when these unexpected events do occur like COVID, these business owners can move much quicker with proper real-time transparent financial numbers and greater knowledge of the business and the impact that such an event like COVID would have. So this diagram is quite busy, but what this is a summary of the way a small business can effectively implement a strategic plan and the mechanisms and processes around a plan to ensure the success of the business. Now, as advisors, you can look at each stage or step and identify with your client what areas you can add value to the process. For example, external environment. This is clearly where COVID would sit. An urgent meeting within the business would have been held to discuss what impact and what steps needed to be taken to protect the business during these uncertain times. You may have actually participated in those meetings and assisted them in determining the cash flow impact. Now that we're coming out of the COVID protected environment, a business and its owners need to assess what the new world may look like. Now, you as advisors can assist in possibly preparing accounting information on what trends you can identify from the last 12 months of trading since COVID appeared. You might see where businesses have strengthened, and you may work with the business owners and management to see what changes are permanent or what are temporary. Now, in each of the steps outlined in the diagram, you could play a role, but as a minimum, you should be asking your clients, are you taking or are you considering these steps now? If so, how are you approaching these steps? Now, while business owners are now operating in more uncertain and unpredictable times, this means that the business owner and key stakeholders need to be across the business, and the need for strong transparency around financial performance is absolutely paramount. So to assist your client, it's important that the business owner and key stakeholders are unclear on what is a board function and what is a management function. Now for small business owners, the reality of such separation of functions doesn't exist because the business is too small for such a separation to occur. Usually the typical small business client will be the director. They'll also be the CEO. They'll also be the shareholder. And in some businesses, there are also financiers through director loans. So conflict exists all over the business, and this is unavoidable because the business is too small and heavily ingrained in the personal lives of your clients. So how does the business separate such functions? Well, here is where the advisors can assist by playing that independent role, being that independent counsel when they can reach out to talk about these separation of functions. For example, while management might be charged with building culture and seeking board's counsel, you as advisor could be that person that they seek the counsel from. Putting in place a regular catch-up each month or even fortnight might be the approach. That way, the business owner has a sounding board with which to seek input. It is most likely that your client is an expert in their field of business, but what are their skills like when it comes to accounting or legal? Now, other areas of separation relate to setting a risk appetite, framing decisions on strategy, and shareholder and stakeholder engagement. Now, you might not have the expertise in these areas, but you can certainly recommend an advisor that can assist, and failing that, having those contacts, you can reach out to networks like Worrells to ask for help in introducing you to the right expert. So to me, this kind of proactive advice is where advisors will ultimately be. As compliance and tax work becomes more automated, we must evolve our role as advisors, and certainly this time now is the opportune time to get your clients educated on this role. Often in small businesses, we see a relaxed or ignorant attitude to the legal responsibilities of a director under the Corporations Act. In failed entities, we will rarely see properly drafted minutes or regularly held director meetings, and no consistent documenting of resolution whatsoever. In matters where the courts appoint us as a court-appointed liquidator, receiver or statutory trustee in disputes, in most occasions the reason for such dispute is that the shareholders or directors disagree on what was agreed upon. Business cannot produce properly minute resolutions, and as such, the court must rely on the verbal conversations outlined in affidavits. Again, as advisors, this may be the opportunity to ensure that the business properly document their decisions and the directors are fully aware of their obligations to act in a proper manner. We often see directors withdraw money from the company's bank account for personal use and then fail to properly account for those monies for the purposes of dealing with such laws as Division 7A loans. The business owner should spend some time ensuring that the processes are set up properly to deal with the proper accounting and legal treatment of running a business. Apart from attending a director's course like the Australian Institute of Company Directors, they may also look to their advisors to assist in ensuring the documenting and implementation of the process is set up correctly. Also, programs like Xero and MYOB become more sophisticated and intuitive. These legal obligations can often be automated, so in situations where there are disputes, then reviewing the well-documented paperwork or processes can often resolve a dispute very quickly and avoid costly litigation. Now, since COVID, we've seen many disruptions to our lives and our businesses. We've witnessed how it has impacted ourselves, and it has really pushed the tolerance limit on individuals to embrace change more than ever. Prior to COVID, we were seeing change being forced upon us through digital disruption. And while we could all see the future, what it would look like, realistically, it felt like it was years away. Now, what the COVID experience did in some situation was significantly accelerate these permanent changes and introduce some temporary changes into the mix. Many businesses have thrived. Many businesses have thrived since COVID, and whilst there are many reasons for this, a major consideration was that these businesses were very good at quickly changing and aligning their businesses to the more permanent changes impacting their industry. The adoption of technology has most likely been at its greatest level since COVID commenced. Take, for example, Worrells. We have seen how quickly we were able to move to a work-from-home solution without any impact whatsoever to our business. Our business had been set up prior to COVID to do just that, but it was really COVID that tested the limits and capabilities of that approach, and we were remarkably pleased how well it worked. The use of Teams and Zoom commenced in earnest in our businesses, but both those platforms are now well ingrained into our business model and culture, just like many other business models do today for your clients. So the point here is that COVID was thrust upon us unexpectedly. We were forced to adopt changes like never before. And so as advisors, we are now well on top of dealing with our own changes. Our clients have most likely adopted many of these changes. And the key to moving forward for them is to assess what changes have become permanent and what are temporary. A JobKeeper, for example, is a temporary change. But what we have heard from many of our accounting contacts is some incredible conversations that they have had with their clients about them complaining how JobKeeper is coming to an end. JobKeeper was always meant to be temporary. If your client has gotten used to receiving this support payment, they need to work on revising their attitude and with regards to the generation of revenue. And whilst the advisor may not know the industry of their client as well as their client might do, the advisor can ask questions around what have been the permanent and temporary changes, and then lead into a discussion around what more does the business need to do to ensure their ongoing success. This is possibly where the strategic plan might need to be changed. So some examples of temporary changes are the government initiative measures such as JobKeeper, rent reductions and waivers, tax relief, banking relief, home builder grant, wage subsidies and state government incentives. All these will be removed at some point in time if they haven't already. Now, more importantly, what have been the permanent changes? What have been the changes to the workforce and employee expectations? As a business owner, you and your clients need to ask which clients are required and who is no longer required. Communication channels for business owners have changed also. So, for example, legislation was introduced to allow legal documents to be witnessed through video conferencing rather than in person. Creditors' meetings in insolvency matters were changed to be held exclusively through teleconference and Zoom or Team type software programs. Those changes are likely to remain. So what has changed for your client? For example, we're seeing in the retail industry today that valuations have significantly increased for businesses that are more online than bricks and mortar. What digitisation changes have occurred in your client's business that will remain in the post-COVID world? So, advisors, how can you exist? Just get that right. Sorry, I'm one slide short. Who is best positioned to advise clients? Now, for advisors, in particular accountants, the key areas that they can best support their clients has not changed. A focus on cash flow, working capital, expense minimisation and revenue generation has always existed. I suppose the main change is that we operate in more uncertain and unpredictable times. So the advisors need to interrogate a business owner and to consider some of the following questions, such as, does the business now need to retain a greater amount of cash for these black swan events? Or do they need to diversify their products or service offering to deal with these unexpected experiences? Do they need to restructure their employee numbers or retrain their employee numbers to embrace the permanent changes that the business has seen occur in the last 12 months? Businesses need to innovate more than ever. And whilst the degree of innovation can vary and is even debated amongst business owners and advisors, what is certain is that the discussion needs to be had, and mostly needs to be had often. Now, I suspect that also that many businesses have taken advantages of soft recovery approaches undertaken since the bushfires by the ATO, and as such have not kept on top of their tax payments. This is an obvious and easiest support offering for accountants, where they can negotiate payment plans with the ATO and various revenue officers. We expect that the government will continue to be very supportive of COVID-impacted businesses. The only question we don't know the answer to is what that new support package or initiatives the federal and state governments will be offering to business post-JobKeeper. Now, for example, we've seen the support around the tourist and the local tourism through the half-price flights. So these kinds of policies come up regular and often unexpected. So what are the options available? It's essential that strong communication occurs between you as the advisor and the client during this period of post-COVID. Strong communication must be regular and often, as it most probably was during the COVID period. When you see the steps to take in this slide, they are obvious and easy to implement, but often what we see in business owners is a lack of organisation or discipline to ensure this happens. For example, a builder may be more concerned about the phone call to the supplier to pour the concrete, rather than sitting down with you as the advisor to discuss working capital. It's okay to postpone that meeting, but make sure it actually happens. The point of undertaking these regular meetings is to ensure that the cost to pour the concrete is actually profitable as part of the project than a client just guessing that it might be making them money. Putting in place proper processes to calculate and visualise profit might be the outcome of this discussion. This might sound extreme and fanciful, but the key to strong communication is really about regularity and transparency. Now, for some of the stronger business owners, they might want to take a deeper dive into their numbers. Financial ratios exist and are commonly considered key to determining solvency for a going concern business. And this is done through the use of the financial data, assuming it is accurate and up to date. For those business owners that really want to perform, they'll often be strong on debtor collections and have long pay periods. For the creditors long pay periods for the creditors without introducing an impact to its supply. The working capital, in other words, is very healthy. The better that the working capital is performed, the greater amount of free cash there will be. The ratios can easily be set up in accounting packages today, so long as your business owner spends the time or even spends the little money that needs to be done these days to get it set up with these ratios. And they can be made easily available in your regular catch-up. Now, in interpreting some of these ratios, we as liquidators are required to investigate the solvency of the company and report this both to creditors and the regulator ASIC. In those reports and working papers, we undertake calculation of the current ratio and other key financial ratios. If the current ratio is less than 1.5, then there is a solvency concern. There is no reason whatsoever why a healthy company cannot undertake similar calculations. Whilst a strong and profitable business may have ratios nearing 3 or greater, at least if they see a trend occurring, they may be able to manoeuvre earlier to stem off any potential gradual slide towards insolvency. Now, putting this into a COVID solvency context, there may have been many businesses that saw a sudden and sharp move towards the insolvency point. Whilst the ratio analysis is likely to be on the back burner during the initial stages of the COVID crisis, we're now coming out of that period, and the calculations for that period may highlight whether the business is returning to normal ratio numbers or is there a new trend being established. Now, this slide continues some of the other areas of financial performance that a business can assess. My view is that when the advisor and the business owner catch up for their regular meeting, they may well wish to table and spend some time on assessing each of these questions. Certainly coming out of the COVID period, the business owners should be engaging in lengthy sessions to review the financials and the trends that were occurring during the COVID period, so they can gain a better understanding of what the business now looks like. And small businesses, often cash flow is ignored. What perplexes me with business owners that fail is that we rarely, if ever, see a cash flow statement. What's the point of trading a business if you have no visibility on your available cash? Often I hear business owners say to me that they measure the business's cash flow from what is in the bank account. We've also seen in recent times that business and individuals have increased their savings by as much as 20%. Josh Frydenberg, our Federal Treasurer, came out as recently as January 2021 to say we have $200 billion to handle the post-COVID crunch. That's a pretty interesting statement. What we don't have real visibility on as an economy, though, is how many business owners are pay their taxes up to date, the creditors up to date, what's been deferred. Also, how many of these clients have entered into long payment plans with the ATO? Do we actually, we understand that the total debt bill for the ATO is around $50 or $60 billion, well up from its historical numbers of around 30. Now, how many business owners owe their landlord an amount for deferred rent? How many businesses have exploited the temporary law changes to the issuing of statutory demands? Could this whole build-up on unenforceable and accrued debt be more than $200 billion? Unlikely. But there are certainly companies that have fared more poorly than others during the COVID period that have taken advantages of the protective measures put in place by the various state and federal governments. So this is where the cash flow statement will be useful. If, for example, we see a 30% drop of revenue during the COVID crisis, the likelihood of expenses dropping by 30% is unlikely. So an effective profit may drop by 50% or more. The bump in revenue caused by JobKeeper and the cash booster will assist, but the reality is that post-COVID, those nice cash injections and support payments simply won't be there. And combined with the level of likelihood of creditors, landlords and ATO to commence recovery action for these old debt, it would seem to me that now is the right time for you as the advisors to work with your clients to build a proper cash flow and to better understand what catch-up payments may be required and how long those catch-up payments could be spread over the next coming periods. So if the catch-up is too much, then insolvency and restructuring options come into play, such as the new small business restructuring process and simplified liquidation. We'll discuss these options later in the presentation. So on this slide, I've mentioned several times throughout the presentation the importance of working capital. Working capital at its simplest is a focus on the mechanism you implement with regards to creditors, debtors and inventory. All these balance sheet items are considered short-term and change regularly and often within a 12-month financial year. The collection of debtors drive revenue and create available cash. Trade creditors provide product or services to ensure the business can deliver on what it wants to sell or provide to its own customers or clients. But creditors also reduce available cash. For those businesses that have inventory, Inventory provides the products to sell to the customers. Now, if we put a COVID spin on this, on how it has impacted working capital for business, there are several issues that arise for each of the working capital components. For debtors, what do they look like for your clients? If you're a tax accountant, you can bill in many ways, from payment upfront to payment on lodgement of the tax return, or through a 30-day invoice approach or some other mechanism. But however, for a retailer, there may actually be no debtors at all because their customer base pays either on purchase or through a credit card or the likes of Afterpay. And many retailers now sell products online. So debtors may not be the driver of revenue for a business, but rather foot traffic in the shopping centre or number of clicks on their website. Your client needs to define what the debtor cash driver is and work initiatives around that. During COVID, many stores could not trade, so how did they innovate themselves to survive? These are the kinds of questions that can also be asked now through the lens of the post-COVID recovery. Link the permanent and temporary changes back to what now generates revenue, or what might generate revenue going forward. Has the business's online sales grown from 5 to 50%? On the creditor front, whilst working capital may have looked strong during the COVID period, you now need to dig deep into the creditor pool to see what, if any, of the creditor pool has been accruing is unresolved and old debt caused by the luxury of the statutory protections and the soft recovery approach by the ATO. Furthermore, business owners have committed themselves to creditor contracts for products that may not be in demand now because of the permanent changes that have caused as a result of COVID. So look at how do you exit those contracts? How do you restructure the contracts to ensure that it's not impacting the business adversely? Inventory, in my view, is a permanent and lasting issue to consider irrespective of COVID or not. What stock is moving and what is not? In one matter I was engaged to do a working capital review by the client. They had got to the point they were on the verge of running out of cash. When I arrived, they were a manufacturer of a product that was sold in places like Bunnings and other hardware store-like businesses. At the first meeting, the client asked me to go for a tour on the warehouse. What was interesting as we walked through the warehouse was that there was a thick layer of dust sitting on a significant amount of stock that seemed to have taken up 3/4 of the warehouse. Now, when I asked them why that was such the case, what it was that the client did not want to sell this stock even though it was slow moving. Now, they had options to put it to auction, but the auction would have resulted in a significant lower amount. But what was sitting in that warehouse was a very quick solution to how to resolve their cash issues. In the end, the engagement lasted about a week. The old stock was sold at auction and they resolved their working capital immediately, and to this day, they've traded very well. So the point of the issue is sometimes you need to take a loss on certain stock to ensure that the cash is freed up, because if it is slow moving stock, it is just that, slow moving. So so in terms of the facility review, we're currently experiencing record low interest rates, and we do not expect those rates to rise for several years as the economy comes out of the COVID-induced slowdown. As a result, these low rates flow through to all forms of finance facilities. As an advisor and with your client, you should always be looking for better and cheaper ways for your clients to fund their structure, their business. Consider either undertaking an assessment yourself of the client's financing structure, or seek help from experienced finance brokers like Stanford Capital, the people that we did a joint presentation on the real property market recently. This review may very well find additional working capital or savings through cheaper facilities, which enables the business to recover and even excel by taking advantage of that extra cash. Now, what should you as advisors do when you are confronted with a client who's in the initial stages of financial distress? The most appropriate course of action is to allow the client to articulate what it is that is causing the distress and how severe it is. The advisor should review or even update financials, check the bank balance, review what the creditor and debtor position is, and work out if there's sufficient future orders that might resolve the current solvency situation. In other words, get to the root cause. If the financial distress of the client is bordering on insolvency, then there must be urgent action taken by the client to deal with their obligations around avoiding trading a company whilst insolvent. You'll often hear in any Worrells presentations that businesses should not incur any further debts or possibly cease to trade, and if necessary, consider approaching an administrator or liquidator if they're in severe financial distress. But the fact that you're actually having these conversations with the client correlates to the fact that your client is actually in financial distress. It might be at that point that you consider reaching out to restructuring insolvency experts like Worrells to sit down to discuss the options, which will... Now, under these options, under the final part of this presentation, we'll touch on these insolvency and restructuring options that a client and their advisor could consider when a client has got themselves into financial distress. Now, the next two slides are quite detailed, and I won't go into chapter and verse of each potential option, but rather for advisors, the options set out are the points that a restructuring and insolvency expert like a Worrells Partners can discuss with your client when the need arises. With the recent introduction and passing of legislation, we now have two formal restructuring options. There's the old voluntary administration process, and there is the new small business restructuring process. Now, the small business restructuring process only applies to businesses with creditors totaling less than $1 million. In our last seminar series, we discussed in detail the small business restructuring plan and the new simplified liquidation option that the federal government passed over the Christmas period. These have now allowed additional formal insolvency options to be available to small businesses that are in financial distress. I've also included the option of receivership because it's important and imperative that your client is aware of these options, because they can often happen suddenly from a director's and advisor's perspective. As advisors, you may be very well dismayed at the appointment of a receiver because you simply were not informed by the client that they had been receiving demands for the repayment of facilities that had actually expired, or they had actually failed to make payments. During recent times, the banks and the non-bank financiers have been very supportive of borrowers, and as such, we haven't seen a huge amount of secured creditor receiverships. But as we roll back the COVID-protected environment, we may well see these non-bank financiers wanting to take further action, or at least see some proper repayment of their facility. So this is where possibly a refinance may be, as I discussed earlier, may be an option. So as advisors, get across your client's finance facilities. Whilst we have seen in recent years the growing variety of great non-bankers, it can sometimes be hard for a client to understand which funders are charging reasonable rates of interest and charges. At Worrells, we spend a significant amount of time researching and meeting and in some cases acting for these non-financiers. So you should also think about speaking with a Worrells partner about refinancing options for your business. Or we can introduce you to other advisors and point you towards very reputable and strong brokers and advisors like the Stanford Capital, as I mentioned earlier. We have contacts like Dom from Stanford Capital in our network that have worked with, vetted and recommend assisting your client if necessary. Now, in addition to the formal options, there are also other informal restructuring options that are available to clients. The safe harbour is one option that I'd like to spend a little bit of time discussing now. During COVID, we saw the temporary relief of insolvent trading. Whilst what this essentially did was eliminate the need for a company to enter into safe harbour protection. Now, safe harbour is when a company determines that it may be insolvent, and rather than appoint an administrator or liquidator, it resolves to enter into this safe harbour and engage in a formal review that aims to provide a better return than liquidation. Whilst this review is underway, the directors are protected from being sued for insolvent trading. There are several qualifying criteria, however, such as including the tax lodgements being up to date and employee entitlements being paid up to date, that the company and the director must ensure before it can qualify for safe harbour protection. Now, since 1st of January 21, we've seen the removal of the temporary COVID protection measures over insolvent trading, which now means that the directors need to now assess whether they should immediately enter into safe harbour or not if they believe they are in financial distress. So linking this back to the advisor's role, each of you should look at your client base and identify those that are behind in their tax payments as a starting point, those that might have a build-up of creditors, or those that continue to exist on a reduction of income. Then you need to hold a meeting to determine whether they should enter into safe harbour if you believe they're in financial distress. Again, given the specialised nature of safe harbour, this may be covered off with a restructuring practitioner. And that is certainly something that Worrells can assist your client with. If it's determined that safe harbour is the appropriate way forward, then a restructuring plan outlining the steps that will be implemented during safe harbour is required. And that plan must provide an outline on how it will provide a better return to creditors than a liquidation or administration. So this all sounds very theoretical, and to some extent it is. But safe harbour can work in a practical sense. It just needs a significant amount of effort around communicating to key stakeholders such as employees, banks and unsecured creditors, as well as a willingness on the part of your client to make difficult, tough and quick decisions. What we have found since the introduction of safe harbour as a profession is that it has been implemented quite successfully on larger clients. I suspect with the recent passing of the small business restructuring process, it is possible that the government identified that the safe harbour process was not realistic for small businesses. So do consider that small business process that has now been introduced. Okay, so let's make sure I'm on the right slide. So what happens if your client does not qualify for safe harbour protection? In essence, not much changes other than the client does not have insolvent trading protection. Again, a restructuring plan can be still developed, and restructuring steps can include the strong communication detailed in the safe harbour process. And whilst there is no legislation assisting them like safe harbour to achieve that protection, it's still prudent for directors to pass a resolution that they have commenced a review to potentially restructure the business and have engaged an expert to assist. If the restructure does fail, then at least if there was any review by a liquidator, the directors may very well have a defence to insolvent trading that may occur down the track should the company ultimately go into liquidation. Now, what are the other tools? So here we now have the new options called the small business restructuring process. Now, during COVID, we all saw very urgent financial support and legislative measures implemented off the back of the expectation that we would see, most likely this year, a huge increase in insolvencies. Suddenly, the insolvency industry was thrust into the limelight, and it was an opportunity for the federal government to undertake a significant review on how to manage this supposed increase in insolvency. There were contributions from many so-called and actual experts of SME, and whilst most of those experts had never actually worked in SME, but rather on larger matters, the government and the public listened to them. As a result, this process was introduced. And what this aims to do is allow a small business with less than $1 million in creditors undertake a restructure akin to a debtor in possession model that's undertaken in other jurisdictions. Like Safe Harbour, it requires a restructure plan to be developed, but unlike Safe Harbour, it is done under a formal appointment of a small business restructuring practitioners, and creditors get to vote on it. So as an advisor, this is another option which is worth involving a restructuring practitioner to assist your client with this process. Now, another option for directors is that they may just simply want to engage in an orderly winding down. Now, this avoids an insolvency, but does require the director to pay out all creditors in full. So in what situation could this option be undertaken? From a post-COVID perspective, the client may be in an industry that has suffered from permanent changes. And this may very well see that their once very profitable business will not be profitable going forward because consumer, customer and client changes during COVID are remaining. So rather than diminish their personal wealth and continue in an industry that has changed for the worse, they decide that the winding up option will protect their personal wealth and avoid future insolvency. And there may actually be tax benefits that go with that. This is where you as the advisor can hold those discussions, and if it's determined that such an option makes sense, then review how to most effectively wind down the business from a cost perspective or a tax perspective. Now, distressed sales have been very common in the last decade or so, where market players like Allegro identify a solid business and provide working capital, usually in exchange for a hefty percentage of ownership, to steady the ship and return the business back to being a profitable entity. Now, this may be an option we might see happen quite often in 2021 or 2022, as I suspect many businesses have suffered and may be unable to recapitalise themselves through either a refinance or an injection of their own funds. The business owners may want to explore such an option, even when it is determined that the injection of capital can be funded through a related party. Those related parties may very well want equity to protect their injection of capital. So in advising a client wanting to move towards a distressed sale, you should assist their client either through structuring a sale from a tax or legal perspective, or introduce them to contacts that could advise them in finding a buyer. Certainly, if you don't have those contacts, the Worrells community, which we'll discuss later in this presentation, have connections within a network that hold all those necessary skills, and reach out to your Worrells contact to ask for a referral or a contact name. So just to summarise the presentation, I would like you as advisors to consider the key points to today's presentation. COVID has created more uncertainty than ever before. Business owners must be agile and ready for change. Business owners are out on their own now as the legislative protection afforded no longer exists, and we certainly have seen the end of JobKeeper this month. When a business owner sits with you as their advisors to review their business, all options should be on the table. Once the financial position is known, assessing each option is essential. Assessing working capital is key to any successful business. Business owners should seek your assistance in this assessment, and possibly as advisors, you could consider proactively reaching out to your client to see whether they are prepared to work with you in a greater role to ensure the success of their business going forward. And that was most likely happening during the COVID period. So let's try to keep that going forward. And just finally, as I mentioned earlier, we have this initiative called Worrells Community. And what this does is it connects you with all the experts that reach out and are part of the Worrells network who attend these seminars. And this is for those accountants or lawyers or other parties that need a particular expert and don't have their own personal contact. Feel free to contact one of your Worrells contacts or email our marketing department, and they can certainly put you in touch with a reputable advisor that sits within our network. But thank you for the presentation today. I'm handing it over to Nick to run the questions.
Thank you, Simon. Yeah, we're happy to take questions now. We do have one that has come through, Simon. The questions around the asset management web app that you mentioned earlier in your presentation. I think the attendees just after the name of that web app, something probably we can happy to provide details of that after the presentation to that relevant person.
Okay, absolutely.
Yep. I don't see that there are any other further questions there. So unless there is anything that pops up, no, we're all good. So look, I'll probably proceed with the closure of today's presentation. Thank you to you, Simon, for presenting today's topic, what is an advisor's role during the COVID recovery? Like Simon mentioned, I think we are at a critical juncture in our economic recovery. Now is the time for advisors to use these tools that Simon has spoken about today. Get in touch with the client. Simple things is just picking up the phone call and having a chat, and just touching base with them as to how they are going. As Ivan mentioned earlier, we have recorded the webinar and we will be circulating details for people to access it in conjunction with providing everyone with CPD certificates. To all of you that attended today, thank you for joining us, and we are looking forward to hosting you at episode 2 of this year's Worrells Webinar series, which is scheduled for late April with Worrells Sydney partner Graham Beattie. More details of that webinar will be released shortly. In the meantime, if you have any personal or corporate insolvency related questions or client specific queries, please do not hesitate to contact one of the Worrells partners. thank you all again for joining us today. It's a goodbye for now from the team here at Worrells. Have a great day. Thank you.